Thank you. Thank you very much. So my name is Jason Tomlinson. I'm the Vice President of Business Development for Hummingbot. I'm going to say something that never gets said at blockchain conferences. This is financial advice. All right. Now, it's going to have absolutely nothing to do with investments and absolutely nothing to do with which tokens to buy. What we're going to talk about is a fundamental concept of markets that is frequently overlooked as companies enter into digital assets. And that is the exciting topic of liquidity, often called the plumbing of financial markets. So let's get into it. First, I'm going to tell you a little bit of background so you know where I'm coming from. Then we'll get into definition of liquidity as it applies to digital assets. And then I'll give some pointers about if you are getting into digital assets. If your company is entering into this realm, what should you be looking at when it comes to market making and liquidity? So Hummingbot is the leading open source market making bot. We've had, I think now it's up to 117 different individual contributors. It is a market making and arbitrage bot only. There are no directional strategies. But the cool thing about Hummingbot is it's always been focused on joining centralized and decentralized. So we have over 30 centralized exchanges. I think we're up to 5 or 6 major protocols, and we're adding more and more every day. And the idea is that this is a free toolbox that anyone can use. It's open source so that you can actually provide liquidity for your token, or you can be a market maker. I think it's often quoted that 60% of NASDAQ trades go through Citadel in the US. I think you need about a $10 billion balance sheet in order to do that. This is free software. If you have $5 in a computer, you can be a market maker in crypto. There's actually 2 parts to our ecosystem. One is the Hummingbot Foundation, which owns the open source code base. And the other is a company called CoinAlpha, which actually created the code and set it free in October of 2021 as a DAO. And so the DAO operates with about 11 people in 7 countries. We operate as a US-based fintech software company. All total, we have about 63 employees over 24 countries, so we have quite the global spread. So why does CoinAlpha care about liquidity? Where did it come from? One of the founders, Mike Fang, actually takes credit for the 2008 financial crisis because he was at Citi and wrote some of the first CDOs based on subprime mortgages. So that experience led him to be much less satisfied with traditional finance and seek alternatives. This is a white paper they wrote about decentralized market making during the crypto winter of 2018, and I found a little section of it that I thought was very interesting for today about the possibility of unlocking liquidity for previously non-tradable assets. And I think that's where a lot of the value in blockchain and distributed ledger technology comes from, is actually adding liquidity to what has previously been non-tradable assets, like possibly ownership in a small company, possibly friends pooling together to buy art. All these things are enabled by crypto. So now we move into kind of what is liquidity and why is it important. And I want to make clear up one thing. A lot of people, when they hear the word liquidity, particularly if they work in finance, they think, oh, that means how quickly I can actually turn my hard assets into cash or something equivalent. How liquid am I? That's not what we're talking about here. What we're talking about is market liquidity, which has several characteristics. So this is not about financial liquidity, this is about market liquidity. So there's a few elements that define market liquidity. Number one, it is essential for efficient markets. If you do not have a liquid market, you cannot, the asset in that market has no value because it cannot be bought, sold, traded. Liquidity is essential, and you see it across, if anyone remembers the Kamichi premium that used to exist because when you could buy Bitcoin somewhere else and sell it in South Korea due to their closed borders, that was an inefficient market. This is an interesting point about how liquidity invites participants of varying needs. we talk often in crypto about retail and institutional users. Well, those people actually have different needs. The retail user just wants to load an app on their phone and buy $5 worth of Bitcoin. And so they need a market that has that small liquidity. But a large institutional firm, they want to make an investment of $1 billion. I believe the story that came out when Tesla bought Bitcoin for their balance sheet, Coinbase brokered that, and they purchased it over 2 weeks, over 400 plus transactions. They had to do that because there was not sufficient liquidity in one market without moving the price. And that's what we talk about what liquidity does. It reduces what we call slippage. So if you want to buy $1,000 worth of a token, and you look on Binance and there's only $200 there within plus minus 2% of the price, when you place your order, you will move the price and you will be making a bad trade. Good liquidity is necessary to remove this. So the orange highlighted points, the first three are kind of generally known about liquidity, but here's some key takeaways. Good liquidity lowers risk for all market participants. That person who bought $5 worth of Bitcoin on their app and forgot about it from 2011, if an app existed in 2011 to buy Bitcoin, they're very happy now with and they want to go sell it, okay? So because there does exist multiple liquid markets, that user now has lower risk by owning that asset. Same thing for institutional users. Why are there not more institutional users in tokens other than Bitcoin and Ethereum? There's not enough liquidity. So when the liquidity is there, the risk lowers for all participants. The other takeaway, if you and I come up with an idea to launch the next great token, it can be the best thing, and if we launch it into the market and do not consider the impact of how it's going to be traded, where the liquidity will come from, it will be a failure. Liquidity is absolutely necessary, and it hardly ever occurs organically. All right? Organic liquidity doesn't exist. You have to plan for it. So some people might say, well, okay, cool. I think I know a lot of really good market makers. Oh, last one, I've already told this. It's the plumbing of markets. Okay, before I get to my next point, this is the thing that we're seeing is, this is basically just a chart showing the number of IPOs per year versus the number of tokens. Now, obviously, there's not a direct correlation between a company going public on a regulated exchange and someone launching a token on a blockchain. But what we see happening is we see a vast increase in the need for liquidity in digital assets because we don't know what the future holds, but we highly suspect that more and more items will be traded as digital assets. So tokens are fast becoming the preferred medium to actually wrap or hold assets. So how do we solve for liquidity? So this was my point about large market makers. So if Citadel exists and all the other market makers exist, why should you, as a token project, as an enterprise looking to get in digital assets, why should you bother? Why shouldn't you just write a check? Well, all of the large market makers in digital assets right now, I've got several listed here. These are all very good friends of ours. Please don't take anything I say as negative against GSR, Alameda, Wintermute. These guys play a very critical role for the top 200 market cap tokens. What they are not able to do is scale and serve the long tail. This has become particularly relevant in this recent down market because the liquidity has dried up. There's no institutional participation in the long tail. Retail has gone away. You don't have people just randomly buying tokens because they saw a Twitter feed about it. So the point here is that you have to take control of your own liquidity. Now, that could mean just hiring Wintermute to take care of it for you. But what I'd like to move into the last couple of minutes of my presentation, then I'll open for questions, is because I am in business development, I was told I got at least 2 slides to show my company, so I'm going to go ahead and do that next. So how do you do that? Well, if I was going to do it, there's actually 3 components that I think you need, and I'm just using, well, name brands here. You need a solution for digital custody, such as Fireblocks. You need a solution for signing transactions. We work very closely with the Harmony team. It's unfortunate that they had the hack recently. The Intel report comes out that it was actually not a hack of a smart contract, but actually a problem with key management. The way they handled multisig could have been done better. So you need those 2 things. Hummingbot does not do those things. But once you have those things in place, you then need to do liquidity. You then need to be able to buy and sell or provide the market with your token. And sometimes if you outsource that, the economics are not aligned. We've also seen this in the down market. Market makers who have worthless token options have quit trading tokens because they have no responsibility to. It wasn't in the contract. And their token option will expire worthless, and the token issuer is getting threatened with delisting. They signed the responsibility away to a third-party service provider without the necessary teeth in the contract to enforce it. So you're starting to hear that theme over and over again. You know, not your keys, not your money. The Celsius thing. All these things that are happening, the same thing can happen with liquidity for your token, and it's a real struggle right now for smaller cap tokens. There's really 3 parts to the Hummingbot ecosystem. At the top is the open source project. To the right, we actually run, Coin Alpha runs a decentralized crowdsourced liquidity platform that incentivizes organic liquidity on 4 major exchanges. And then the last part is Hummingbot Prime, which will be coming out next year. Hummingbot Prime is just an enterprise level version of Hummingbot. It'll be closed source, and our target market for that is people who are token issuers. We've already sold beta versions to quant funds, hedge funds, family offices, anybody that needs to manage liquidity regardless of what it is. So hope that gives you some idea. We've got a couple minutes left if there's any questions. All right. Thank you so much. I believe Nikita is coming up with a panel about the monetization of NFT for artists. So they should be coming up in a minute. In the meantime, talks amongst yourselves. Thank you.